Class, and welcome back. This is a chapter 9 video that I mentioned I would be putting up. And in this video, we're going to talk about the variance analysis cycle and flexible budgeting. Now, we're going to look at the variances first before we do the flexible budgeting, because the flexible budgeting is a tool for us to examine what actually happened and figure out, why. So when we look at variance analysis, we're going to start with a performance report to compare our actual results with planned results, analyze variances that we have, raise specific questions about those variances, and then identify the causes for that. And then, of course, we would ultimately take action on those. Well, the flexible budget is a tool to analyze those variances, actually. So if we look at a flexible budget, what it is, we start with a planning budget. We have a fixed amount in revenues and expenses, and the flexible budget then comes in and takes those original planning assumptions and adjusts that budget based on the change in however many services we perform. So when we created the planning budget, we used some specific cost driver assumptions about it that are based on the quantity of services we perform. We apply those then based on the changes to the flexible and create the flexible budget. So one of the things that's a problem in the static budget is you can have an increase in the number of goods you sell and have an increase in income, but it doesn't always tell you exactly why. So here is the planning budget, and then if we go down a little farther, you'll see the actual results, and they have more income than they planned. So one of the things that we need to be able to do is to say, okay, well, why did that happen? Was it because we sold more services? Well, in part that is correct, because we budgeted for 1,000 and we sold 1,100. But there's some complex cost drivers involved here. If you notice back here in the original planning budget, when we created it, we had a planning model for wages and salaries that assumed a base amount of 65,000 plus $37 times the number of quantity of visits we had. And then the same thing was true for electricity. We had a base amount here plus a specific amount for the number of visits, and then same for miscellaneous expenses. Some of these others are purely fixed, like rent, liability, and employee health insurance, but others are directly related to the quantity that we sell, like hairstyling supplies and client gratuities. We know that those are going to be there. So when we look at this and we look at the results compared to the actual, we don't have a complete story as to why the variance took place. Now we do see when we compare the results that revenue is based directly on the client visits. So that's easy one to tell. It's based on activity variance. So we actually based it on 194.2. We based it on 180,000, and we actually sold revenue of, or sold, client visits came in and we earned revenue of 194.2. The difference of 14.2. So that's pretty predictable. That's going to be directly driven by the quantity we sell. However, there may be something built into this that we can't see, and that might be a change in price. Likewise, we have wages and salaries here. We have a certain amount. Here, when we have revenue, it's that the actual results is higher than what we planned. That's a positive or favorable result. When we have expenses that are higher than what we planned, that's an unfavorable result. So you see the differences here that come through. Now, notice in total, we have an unfavorable result here. We have 1, 2, 3, 4, 5 expenses that are unfavorable. That means that the expenses were much higher than what we planned for, but that the favorable revenue variance compensates, more than compensates, and gives us a favorable variance in the revenue of 4,430. So what we're really thinking about when we do a flexible budget is identifying why those changes took place. So we look at the actual results here, and we see these cost drivers that we have. And so when we do a flexible budget, we want to basically take that planning budget and make an adjustment for it based on quantity. So notice we had a planning budget of $1,000. We had revenues of $180 times the client visits, which we budgeted for $180,000, but we actually had $1,100 here, and that gives us $198,000. And that's an activity variance, because when we created the flexible budget, we're basing this entirely on the quantity. So we're adjusting this planning budget for the quantity. This is not actual results. This is the planning budget adjusted for the quantity difference. Wages and salary, we adjust based on the quantity, and the difference here would be 100 more visits times $37 plus whatever they had before. So you'll have the $65,000 plus $37 times 1,100 units. Hairstyling supplies, client gratuities, those are going to be based on the total quantity that we have. And when we say we have 1,100 visits, we're going to take that times whatever the amount was that we determined was what we could budget for it. And then we get into electricity. We have another mixed expense. We have a base amount plus 10 cents for each visit. So we're going to multiply this 10 times the 1,100 and add it to the $1,500. We get 1,610 here. And so you'll see these variances that are occurring. Now, once we adjust the planning budget for the flexible budget and compare it to the original, that difference is the activity variances, because we've adjusted the original budget based on the activity level that changed. So we also have another kind of variance that can be from revenue and spending. So when we're talking about revenue and spending, we're saying, okay, well, we've adjusted this planning budget based on quantity. Now if we compare the adjusted budget or the flexible budget to the actual results, we should have compensated for any change in what the volume was. The resulting difference then will be basically the revenue and spending variance. So here we've calculated the flexible budget at 198 compared to on 1,100 visits. Compared to the results, we have 194.2. There's a $3,800 unfavorable spending variance, which means we did not receive $180 per visit. We budgeted for that, but we didn't get it. Wages and salaries, if we adjust for the activity, we get 105.7, but when we compare it to our actual results, we show a $1,200 unfavorable variance. This means that our spending was higher, not based on the quantity, but based on the spending. Hairstyling, client gratuities, all of those things we go through and recalculate the difference between the flexible budget and the actual results. We get down to the bottom and we see we have a $9,280 unfavorable variance for revenue and spending. That's based on what we have budget. That's based on what we actually did compared to the budget we've adjusted for our actual activity. So these things, this comparison that we're doing, will help us to isolate what problems occur where. And this is a part of the function of managerial accounting. So really, when you get into managerial accounting, you're really looking at why did these differences occur and how can we isolate these different impacts. So for example, we combine all of those exercises I just showed you into this one worksheet. We start with a planning budget. We adjust it based on volume to the flexible budget. And you notice if we take the planning budget based on activity and change it, we calculate a new net operating income of $30,510. However, we compare the flexible budget with the actual results. So we're saying, okay, the flexible budget is adjusted for activity. We compare this to the actual results, and we get the revenue and spending variances. All right. Then we take the flexible budget that we calculated based on activity and subtract out the planning budget to get the variances we have based on the activity levels that we saw. So what you see here is that this variance between actual results of the planning budget boiled down to an $18,000 favorable variance on activity, but a $3,800 unfavorable variance on spending and revenue. That difference makes up what you see when you compare the budget to the actual results. This makes a lot more sense in managerial accounting because you're trying to isolate the problem and figure out, okay, how do I fix this? If this is a problem, did I have a problem with charges here? Did I charge people enough, basically? And why is my wages and salaries over budget more? Well, actually, they're not. They're wages and salaries. When you compare the unfavorable variance here with this one here, yeah, you see that this unfavorable variance is largely due to activity. There is a small spending variance, but that's not as significant as the activity variance. And likewise, it turns around the other way. When you look at gratuities, you see you have a much larger unfavorable variance based on spending than you do based on activity. So anyway, that's how we compare those three items together to basically come up with the causes for variances between the actual budget that we planned for and the planning budget, and between the I'm sorry, I didn't mean planning budget, I meant flexible budget, and between the flexible budget and actual results. Anyway, so that's really the crux of this part of this chapter 9. There is some other information here about flexible budgets with multiple cost drivers, and that's what we were looking at when we actually calculated it based on the mixed costs. So if you're looking at multiple cost drivers, what it really means is you may have two different quantities that you're looking at. Instead of one quantity, you're looking at two different items. So, for example, here the electricity is based on a flat rate of $390 plus 10 cents for quantity 1, which that's client visits, and then plus $6 times quantity 2, and quantity 2 refers to hours of operation. So what you're doing here is you're looking at two different activities that are cost drivers and calculating the amount of cost that you have involved. This faulty analysis here, this really is the conclusion of the chapter, and if you notice, you can calculate these variances and incorrectly identify what you're looking at. I mean, the math is correct here, but basically what you're looking at is, this is too simplified. You compare the actual amounts to planned amounts, and you're assuming that all income statement items are fixed. They're not, and so you need to account for that. So anyway, that's chapter 9, and if you have any questions, let me know, but that will help you with the assignment for this week with the activity, and I look forward to seeing you guys again on Monday.